right, we are live. Axel, thank you for joining us today. How you doing?
I'm doing great. Thanks for having me. I'm really excited to chat about some real estate here.
We'll love it. To get us started, why don't you go ahead and tell everybody who you are, where you're from, and how you got started in real estate in the first place?
Absolutely. So, my backstory, I'll try and make it quick here, but it's pretty similar to, a lot of people that get into real estate, right? I've been a quote unquote entrepreneur forever. Sold anything I could get my hands on from, middle school up until now. So, that's the overall background. And the way I found real estate specifically was in high school and through first couple years of college, I would actually buy and sell used cars on Craigslist. And
Oh, nice.
so that was my nice little side hustle. That's how I was making money and, trying to stay away from an
Ironically,
office on the summers between school. So,
ironically,
um,
that's how my partner right now got started in buying and selling used cars. So didn't mean to jump in. Keep going.
no, that's great. I mean, it's a solid business. And so when I was doing that, I was like, all right, what can I buy and sell that's a little bit bigger than this? And, where's the next step, so to speak? So I started watching, HGTV in my spare time. I was watching all the house flipping shows, and I was like, all right, that sounds like a pretty good next step. A little bit, more expensive than cars, makes some more money. So I went out and got my real estate license. Not that you need it to flip houses, but that was like, hey, I'm 19, I might as well get this. It's cheap and easy to do, and I was living in New Hampshire at the time, which is one of the easiest states to get your real estate license in. So I was like, might as well get it. So got that, and then, the next thing I knew, I was doing all this research online, trying to figure out how to flip houses. And I came across rental property investing. And, the idea of buying a rental property and, just receiving the cash on a monthly basis kind of in perpetuity, that really intrigued me. So I was like, that seems like a better business model than flipping houses, which, you came to realize through research is really just a job. And, I said, and the other part about flipping houses too that concerned me was it's significantly higher risk than buying a rental property, just in terms of the financing you need to use. Typically how many the scope of the renovations is higher, and there's just much more ways in which it can go wrong throughout that process. So I was like, let me get into I'll buy a multifamily property, something small, and that's how I'll get into real estate. And a couple years after that, when I was doing all this research, took a little bit, but I bought a 3-unit property as my first deal, and I used private financing to do that. And I was in college at the time, and that's kind of what kickstarted it. And that was 3-4 years ago, and now I own just over 40 units of multifamily property. That's pretty much entirely financed initially with private money using the BRRRR strategy, and that number has been fluctuating over the last couple of years as I sell properties and try and get ready for the next step of my career, which is ideally buying these larger 50+ unit multifamily properties. So that's kind of where I'm at now.
Awesome. I love it. That's a great trajectory. So just to kind of recap real quick, you started, sounds like in high school, you were flipping cars. You just bought and sold cars, which is very similar to buying and selling houses, except for the risk is more and the reward is more on the house side. So you started looking into that. Did you actually flip a house, or were you turned off by the risk factor there?
So I have flipped houses, and it hasn't really been a conscious thing that I've done. It's more or less been a deal, kind of comes your way when you're just, in the business and everyone knows what you're doing. And sometimes deals just come to you that say, hey, this could work as a flip. So I've flipped probably 10, 15 houses the last 3 years. So, not a very large number. It's maybe been 3, 4, 5 a year. There's last year I did a little bit more, but it's certainly not my focus. It's something that happens. And if an opportunity comes up, great. And something that I've done too is if I, even small multifamilies, I'll buy them with the intentions of holding them long term, but maybe, the return on equity isn't there once I go to refinance, or the cash flow isn't good enough to justify holding on to it. And the actual, selling it and recapturing some of that equity makes more sense. So I've flipped, some 2, 3 unit buildings that I originally intended to hold on to. So it's kind of been an accidental flip. So, but outside of that, no, I haven't, consciously went out there and, marketed to single family homeowners or anything like that.
Gotcha. So awesome. So you got started in cars. After cars, you wanted to move on to houses. You looked into flipping, wasn't your bread and butter, and you found rentals, which is, in my standard, in my opinion, the gold standard of being in real estate is having rentals. I love having them too. And then you went on. It sounds like you jumped right into multifamily. You started with a triplex, which is fantastic. And since then, you've been just constantly growing over the past 3 or 4 years, and you're up to 40 units now, it sounds like.
Yeah, so 44 right now. There was a peak of around, it was like low 60s. I had 60 something units. This was about last year, and then I started to overextend myself a little bit, and I was nervous about how many projects I had going on at a time with private money, and I decided to scale it back. So I sold a couple of buildings and started scaling down the portfolio, and this is like late 2019. So I mean, we're talking 6 to 9 months ago here. And it worked out. COVID happened, right? And next thing you know, there's, luckily I haven't had tenants, not a large percentage of tenants, not paying rent. But if if I was kind of operating the way I was, where I was taking on a lot of projects and stretching myself a little thin, that would have been a pretty stressful few months, the last few months. So, I caught myself getting a little ahead of myself, getting a little out over my skis. So I wanted to tone it back. So that's where I'm at now, though, is I believe 44 units is what the portfolio is at.
Gotcha. And it sounds like your overall strategy is the BRRRR method. I can never remember all the R's: buy, rehab, refinance, rent out, repeat. Is that right? There's 4 R's, something like that.
Yeah. It's buy, rehab, rent, refinance, repeat. I know it's like, you typically forget. You don't usually say the words. It's just the overall idea of it.
That's great. So sounds like you're also focused on small multifamily, so not large yet. At least you may be going there in the future. So I love it. You've had a lot of great experience. We really want to get into the bread and butter of how it operates, how you got here. So kind of start out and tell us first how you actually go about finding your properties. I mean, real estate, it's a process, and at the very beginning of that process, you got to actually find these properties. So how do you go about sourcing them? Do you do digital marketing? Do you send out letters? Do you just work with brokers? How do you do that?
Sure. So it's really, I would say 3 or 4 main areas, and it depends on what what strategies you lump into, a segment of that. But it's really just a combination between relationships and marketing. And by marketing, I mean, I do very little direct mail. Maybe I have, and I'll take a step back too. My market that I buy in is a city in New Hampshire. It's called Manchester, and population's just over 100,000 people. And that's not a very large market, right? So if I were to run a list of all the 4 to 25 unit properties as an arbitrary number, I've done this, right? With very little kind of filters on it. Maybe just not having been sold in the last 3 years, that list is maybe 500 records. So, there's just not that many people that own the types of properties I'm looking to buy in that market, which is a reason I'm looking to go out of state now, because I've kind of tapped it out, and that's a whole nother topic. But so I've done very little direct mail. Maybe I'll send a couple hundred letters, quarterly to some owners, something I need to be more consistent with, but that has generated some deals. And it's worked pretty well, and it's multifaceted in how well it works. And that it does, sometimes bring a deal to the table, but it also just puts you in front of a lot of investors in that market. And the interesting thing about doing direct mail to multifamily owners when you're trying to grow a portfolio is oftentimes you'll hit an owner that owns, the building that you pulled the record for, so to speak, as well as 5 or 6 other buildings in the same market. And, a lot of the people that I bought property from, I bought multiple properties from, and which has been pretty key. So that's one element, is direct mail. And then the other is text and email prospecting, which is relatively newer for me. So I'll find the owner, I'll do some internet research here to find their email address, kind of troll through LinkedIn or do a Google search or look at their Facebook or whatever. There's a number of ways to grab someone's email. And then I'll just send them an email asking if they're interested in selling. And then the same thing with text prospecting. I'll reach out via text, skip trace the records and get their phone number. Email has been pretty good. Text is like a coin flip, right? I'm pretty new in that. So I shouldn't say I have definitive results, but email works pretty well. And then the other is really just being conscious about building relationships with folks who are in front of people that own, multifamily property. And I could talk about this for a while, but this is really how I find most of my deals. And it's funny, right? Because when you're doing single family homes, whether it's rentals or flipping, if your seller is typically the seller of a single family home, you can reach those folks a lot easier with marketing. As the bigger the properties go, the more relationships become important in the lead generation process, right? So I'm like down in this 4 to 10 unit space. so it's a combination of marketing and relationships will bring you enough deals to keep you busy. As you go larger, right, you go 50, 60, 70 plus, that almost entirely becomes relationship based business rather than, marketing based. So I've struck this balance between using marketing and building relationships. And by relationships, I mean building relationships with investors and just, getting coffee with folks that own property and really just reminding them on a consistent basis that I'm looking to buy. So when they're looking to sell, maybe they know someone who's looking to sell, they call me. Building relationships with property managers. If they have an owner that's looking to sell, I'd love to be someone they call. Contractors, lenders, just folks that are working with people in the business a lot in different capacities, constantly reminding them that you're looking to buy is really key. So that's probably gotten me like half my business is just through relationships. And, without going too deep into this, a quick story on how I found, I think it was 9 units. This was a couple of years ago. It was three unit buildings. And it was this guy that did painting for me at the time. We haven't done business in a while. He moved, but nevertheless, I wish he didn't because he was finding me deals. But he was just like, he was painting the units of a ton of investors' properties in the area. And I just said, hey man, if you're painting a unit and you got an older seller who's maybe looking like he's or talking like he wants to get out of the business, give him my phone number. And he did that. And I found multiple properties through that relationship. So it's funny where it comes from, right? And it's, so for me, to make this long answer a little bit shorter, it's been a few strategic marketing channels, mainly email, text, and direct mail. And then the other half really has just been through, building conscious relationships with folks that are in the business.
I love it. That's great. So it sounds like it's kind of 50-50 relationships and actual active marketing. And on the active side, you do letters, email, and text. And that's strictly to multifamily owners, sub 10 units. Exactly.
So, the active marketing that I go out there and, pay for, put time into, the channels that you just mentioned are really, it's for 4 to 10 unit properties is really where I'm doing it. And there is still success there, like I was saying, where a lot of those deals still come through relationships, especially in a smaller market, like when I'm in Manchester, where there's just not that much inventory of those properties. You can pull a record of all of them, and maybe it's 500 to 1,000 names and actual addresses, depending on how you filter it. So it's, when it's that small of a pool, relationships are going to be really important. Whereas if you're, you mentioned you were in Seattle, right? I'm assuming that you will probably find a little bit more success marketing to those owners in Seattle because there's just a much larger pool to work with. So for me, I've had to strike a balance between the two. And, other things that I'm looking to do in the future, maybe cold calling or some kind of, content marketing with some kind of paid traffic piece to it. I'm personally just not convinced that will work really well for those types of sellers. But it's something that I'm looking into, but that, those channels have kept me busy enough and given me enough deals to kind of chew on. So it's been good.
Yeah, that's great. And that is one of the main reasons that I started this podcast, is to network with other investors and to remind people that we do buy multifamily and mobile home parks. So if you got one to sell, reach out to me. But okay, so letters, emails, and text. And it sounds like you don't do any digital, which seems to be a pretty popular thing these days. But I guess if you're only focused on one market, one smaller market, it would be less effective because, there's just not as many people there. So great. So that's how you find your properties. You reach out to people, you network with other investors, you do a little bit of active marketing. Once you find this property, actually before that, once you've identified the property, how do you go about deciding whether it's the property that you want to buy? Do you go on cap rate? Do you go on cash flow? What are you looking for when you're actually buying these properties?
Sure. So I use 2 metrics to really quickly evaluate a property and, underwrite it, so to speak, in 10 minutes or less. In my market, price per unit is a pretty consistent metric to use to quickly just see if a property is going to, be worth pursuing or not. And then I can quickly do a cap rate calculation. So for me, let's say that I get a call from a guy that owns a 6-unit property. 6-unit properties in my market are typically selling for, if they were to go on the MLS and they were stabilized and everything was, all the CapEx was taken care of, the rents are at market, everything looks great to like a retail buyer. Typically between 80 and 100, 105 grand a unit is the range, depending on like bedroom count and what the income is.
Pretty cheap.
So say that again.
That's pretty cheap.
Yeah, it is pretty cheap. It's funny, right? You live in Seattle, I live outside of Boston, right? That seems insane to us, but that's typically where those properties sell for. And if they're 80 grand a unit, they're probably 1-bedroom units with lower rents, and if they're 105, they're probably 3-bedroom units with higher rents. So, I know when I'm buying, okay, I got to be between 60 and 80K a unit when I buy. Maybe I put 5, 6, 7 grand in a unit. And then I buy a building at 60K unit, put 7 grand in, I'm at 67K unit. And then once you go to refinance, it'll appraise at 80, 85 grand a unit. Right. So that's how I look at things, if I'm going to look at a deal quickly. And then, it's similar to looking at a single family house that you might be looking to flip, right? You take what the after repair value is, and then you just subtract your repairs, you subtract how much money you want to make, and there's your offer price. So that's pretty much what I do with those. And if I want to look at it a little bit further, then I can look at it on a cap rate basis. So, I'll take what I believe the stabilized rents would be. I'll just divide it by 2, which, is a 50% operating expense ratio, which is a pretty safe number in my market. And then I'll get the NOI, and then I'll just divide it by what cap rates I've been getting in that marketplace. So in my market, depending on the street and the neighborhood, it's anywhere from a 7.5 cap to a 9 cap if you're in a tougher neighborhood. So I say, all right, this market's an 8 cap. The market rents on a yearly basis are 100 grand, 50 grand is going to be my NOI. Divide that by the cap, and that's what I would guess. My offer price should be roughly around, because I know that when it appraisers are typically going to use a 35 or a 40% expense ratio in my market. So that difference, I'll have some buffer there. And that'll get me in at, 80% of market value, somewhere in that range. That's like, if I want to look at it in like 10 minutes, right? I can do those calculations, and then I know, hey, it's telling me that I can pay 400 grand for this property, but this guy wants 600. It's probably not going to be worth my time to give him a call and really just even pursue this. And then if those numbers are close, all right, then I'll go in further and actually get expenses and really look at the rents and see what they are, and, further hone that down.
I like it. There's a lot of things that jumped out to me, actually. So for one, it sounds like you use 50% operating expense ratio. We do 40, but 50 sounds more safe. And so you use 50% OpEx, and then you try to buy at a cap rate at around 8 to 9%, it sounds?
Yeah, exactly.
Wow, that's really good.
And I forgot to mention there too, I'll just jump in real quick. So let's say, it's in a neighborhood where I think the cap rate is 8, that's what an appraiser would give it. That's what a retail buyer would pay. When I do my analysis, maybe I'll do an 8.5 or a 9 cap, and there's an extra little buffer there. And that really ensures that I'm getting in at below market value, and that there's going to be meat on the bone when I, add the value and bring everything up to a stabilized level.
Absolutely. You have to build in your own safety margins per se, when you're looking at properties. Okay. That's really interesting. So you use cap rate and rental values. How do you go about actually finding the comps for rents? Do you use Rentometer? Do you just pull up Zillow, kind of do a spot check?
So it's funny, right? It's like I can't even remember at this point, since I've been in such a small market for so long. After a while you're like, these are the rents, right? But it's interesting, because I'm trying to move out of state, and because I can't stay busy up in such a small market there. So I'm like having this problem right now, and the way I'm doing it currently is I'm using Rentometer. I use Craigslist, and what I do with Craigslist is filter down based on the same bedroom count. And I'll just go to the map, and I'll try and narrow it right into the address where I'm looking. And then I'll ask for referrals for property managers in the area. In my current market, I ask my property manager if I'm unsure about what rents I can get for a unit. I say, are you managing buildings on this street or in this area? Oftentimes, since, they manage a lot of buildings, so oftentimes they'll be like, yeah, we're managing, 1-2 blocks down. They're getting 1,200 for their 2-bedroom. You don't have a dishwasher in your units, you probably get 1,100. So that's the other way I lean on my property manager. But when you're starting out, obviously you don't want to bug, your property manager, especially if you haven't done any business with them. They're probably just going to get annoyed. So, I would rely heavily on web research, right? So Rentometer is great. I do rely on that. I do find that their
High.
rents seem to be high. Yeah.
Yeah.
In every market I look, that's the case. And sometimes I'll, for just so that I can see what it says about my home market, Manchester, right? I'll go look at what it says. I'll put in one of my properties, what I'm getting for rent, and I'll see what it says. And it's like, your rent's extremely low. And I'm like, no, I know that's market rent for my building. So, so I'd be careful with Rentometer. Play it towards the lower end of that range, and you'll probably be safe. And then cross check it with other folks in the market, and maybe Craigslist or Hotpads or Zillow, depending on what site has a lot of properties in that market.
It's funny you said that, because I've actually emailed Rentometer and I asked them, like, hey, can you guys reduce your prices by just 10% even? It's just, you're a little bit high for what, we market nationally, so we get properties from all over the place. And I always double check Rentometer's numbers, and I've never found it to be 100% accurate, though it does give you a good range. And so if you veer towards the back end of that range, you'll be safer that way. So.
Yeah. And I think another thing too with Rentometer is, and I shouldn't say this because I don't know where they're pulling their numbers from, but it seems like they pull it from what a lot of the asking prices for rent are in the area, as well as, maybe what things are actually leased at. And it'd be similar to if you're pulling, comps from Zillow and they're using what the asking prices of all the nearby properties are. That's not what they're selling for. And just someone in an apartment, a guy can ask $1,700 for his unit. Maybe it's only a $1,500 a month unit. So I say that with like an asterisk, right? Like, I'm not sure, but it seems like when I look at their maps, they're using like listings to kind of populate that information, which, could probably skew it upwards.
Right. Yep. So Rentometer, if you are listening, we love you. Just reduce the prices. Just
you're doing a great job. We need you, because it's still a great frame of reference. So
great. So that's how you analyze. And the next step in taking on a property is finding money to buy it. Sounds like you use private equity. How do you go about finding those private investors?
Sure. So I use a lot of private money from folks that aren't in real estate. And I can further clarify that too. So without diving too deep into this story, I did an internship in college where I interned at an angel investment group in the same market that I'm buying in now. And it was just, 10 wealthy guys who were investing in startups. And I just did a lot of the administrative work, arranging the meetings and everything like that. And I met a guy there who he did some real estate lending on the side. Certainly wasn't his like core business. It wasn't a structured business, but he worked with a couple of investors and he'd make loans at 10 to 12% interest. So he was actually one of my early investors, or lenders is the better word. So he was one of my early lenders. And I basically said, hey, look, if I find a deal that looks like this, would you be interested in lending on it? Despite the fact that I'm 21 years old and haven't done this yet. And he's like, yeah, if it looks like this and it's actually a really good deal and I'll run it by a couple people, yeah, we'll talk about it. And that was how I found, the first lender that I really worked with. And as time goes on and you do more deals, just be intentional about finding lenders. If you do a deal, put it up on LinkedIn or Facebook or Instagram and say, hell of a deal. These are the numbers. I thrilled to offer my investor on this deal, my lender on this deal, an 11% annualized return. And people are going to see that number and say, hey, if this guy's done a few of these, he probably knows what he's doing. I'd like to speak with him. So the way I found him over time is communicating what I've been doing in my business, like in a conscious way. I'm not bragging about like what I'm doing, but mainly just, putting up some content and having conversations with people in the market, talking about what kind of deals you're doing, what more or less kind of what the end results of them have been, and what the end result has been for the investors that have invested in them on a lending capacity. So that's really what I've done. And I've broken down finding lenders into three main categories, right? You either have high income professionals, a doctor, a lawyer, someone like that who's making a boatload of money. Stock market doesn't really do it for them. And they want to invest in real estate, but maybe they don't want the hassle of owning real estate. So why not lend on real estate? Or you have, and then you have the business owners who are also making a lot of money, but again, their focus is elsewhere. They don't want to be in real estate, but they like the idea of having some exposure to that and earning some above average returns. And then other folks in real estate, maybe, successful brokers or other successful investors, or, former investors. I worked with a guy who, he sold his portfolio Unfortunately, not to me. I was a little late to that. But I met him and he said, yeah, I just actually sold a bunch of buildings. I'm sitting on all this money and I don't really know what to do with it. And I said, well, do you want to lend? And he's familiar with the whole process. He understands private lending, understands that. And he's like, yeah, why not? That makes a lot of sense. So I worked with a guy that, who was a little bit on the older side. He was in his late 60s, since sold all his real estate. He understood the business, understood the game, and he lent on a few deals. And then, but it's really, it's not like you can do this and that'll get you lended. You just have to, you need a lot of at-bats. You have to talk about your deals. You have to talk to a ton of people, and you have to be really intentional about telling the people that you meet with what you're looking for so that they can go out and find it for you.
Right. It's the cumulative effect of all your interactions with pretty much everybody that you're meeting in the day-to-day.
Yeah, exactly.
And that brings it back to relationships, where you talked about earlier. You find your deals through relationships. You finance your deals through relationships. Relationships is definitely or real estate is definitely a relationship business. And so it all comes together with the people that you're interacting with every single day.
Yeah. And it doesn't even really need to be that hard either, right? So I'm working with private lenders. So, individuals who maybe don't have a company that they're lending out of, right? It's a less formalized structure and they're more negotiable, right? So you got private money and you got hard money. And I've used hard money multiple times as well. And hard money might be easier for a newer investor because, you can just Google hard money lenders wherever you are and you'll find hard money lenders. And, their requirements are a little bit more structured and a little less negotiable, but that's an avenue to get into the business as well. So private money is a little bit better. It's a little cheaper, a little bit more flexible. It's the same thing as negotiating with an individual, right? Than a company. It's two different things. But if you do want to find lending to take down that deal, you can use hard money, and that's a little bit easier to find.
Yep. And I've used hard money quite a bit in my career as well. It's a little bit more difficult. If you have private money, definitely go that route. But it's an option. If you need to take it down, jump on hard money. It's there for you.
Exactly.
So we're kind of at the last of the R's. I guess you haven't gone through rehab, but I'm gonna skip that one because it sounds like most of them that you're working on are relatively stabilized. So we're just gonna jump right to refinance. Refinancing is kind of self-explanatory, but if there are any, I guess, what do you do when you go about refinancing your properties? What's the process you use? Is there any specific bank that you feel like gives you better rates? And then once you get that money, I guess you're not selling them, so you can't do a 1031 exchange, but kind of take us through the process of the final R of refinancing.
Sure. So refinance can be tricky, especially if you're newer to real estate and maybe you don't have. So I'll take a step back and describe my borrowing situation, which is a little wild. So I'm 25 years old. I've been doing this full time for a couple of years now, and even before that, I was working as an agent to kind of pay my bills while I was trying to get it off the ground. So my tax returns are just all over the map. My debt to income is crazy. I don't have that consistent W-2 that every lender that's going to sell their loan off to Fannie Mae or Freddie Mac needs to see. So I don't fit in any of those boxes. So, even on a 3-unit building where you can get 30-year fixed rate financing on it, I typically don't qualify. So I've been forced to go out and use local community banks and credit unions to refinance on the back end of this process. So, my terms and my debt typically looks like, 20 to 25% down, so really the term would be 75 to 80% loan to value, rates in the mid to high 4s, which is higher than what you can get, on a 30-year fixed rate loan. So I'm paying a little bit more in interest, and 25-year amortization periods. So it's a little bit more expensive than that 30-year fixed rate, pretty Fannie Mae debt that's in the 3s in terms of an interest rate. But I just don't qualify for that. I've tried, I just don't. So I've had to go that route, and it's actually been a blessing in disguise because doing refinances with commercial loans and commercial products from local banks is just a much easier process than working with a lender where you have to check a number of boxes in order for them to sell the loan off. So that's typically how I go about refinancing my properties. So, other pieces of this process are, you really have to be mindful that the appraisal, the appraiser and the appraisal are like the biggest part of this entire process. You obviously have to buy right. You have to do your numbers right. You have to, rehab at the number that makes sense. And you have to, all of that you got to do, right? but that's all kind of in your control, more or less. The appraisal is not in your control. You can control it to an extent, but there's still an element of it that's out of your control. So, for me, I've really focused on doing my best to get the appraisals where I need them to be. So when I do an appraisal, I bring the appraiser like way more documentation than I know any other investor does, like an itemized list of all my costs with the, or my itemized list of upgrades with their associated costs, what I've done to the unit in the building. And I'll literally like write out a story of what the deal was, where I found it, what the seller situation was. Why did I buy it at such a low price? Because you're going to get this question every single time you do this. Well, you bought this at 200 grand, you only put 40 grand into it. Why do you think it's worth 300? Like and you got to have an answer for that, right? So I say, I bought it from a distressed seller. It was a distressed situation because the seller and his partner co-owned the building and they had a falling out and they needed to liquidate. So that's why I'm buying it at 200K, and this is what I did to the property. This is how much I raised the rents. This is how we increased the tenant profile, and then just really tell a good story, provide evidence of what you've done, and then also provide comps as to what you feel are good comps, right? And then don't pressure the appraiser and say, oh, this is like the perfect comp. Like you gotta use this one as like the main one. Just provide them the information that helps your case and let them do their thing and just be pleasant throughout the process. And that's helped me get the numbers that I need in appraisals. Because if a number comes in low, and maybe you have to bring cash to the table, and maybe it's a substantial amount, 10, 20, 30 grand, for the sizes of deals that I'm doing that I've been talking about, that's pretty substantial. And if you don't prep for that, it can really, you can find yourself in a tough spot, especially if you don't have the money in the bank. So, those are the things that I really prioritize on the refinance. And a lot of that, becomes easier with time and repetition. But, I think those are a couple of big tips is, local banks are great when you're doing these refinances, especially when you're doing a volume. They can just, they can be really flexible in the terms and the programs and everything they offer you, and they keep that loan in-house. And then don't be lazy when it comes to the appraisal. Do a ton of work to help that appraiser give you the number that you need.
I love it. So you work with local banks, and then you really, you put in the effort to build a picture, to paint a picture for the appraiser. It sounds like you go into incredible detail with the rehab that you did, the comps that you think are apropos to the property. And you really help him understand, take him along the journey that you went through when you purchased the property, and rehabbed it, and now are being reappraised. So I love hearing that. So this is, we try to keep this show to around 30 minutes. So I'm going to move us along here just a little bit. I do want to hear just one experience from you. I love to hear, we all know real estate. It's a roller coaster. You got your ups, you got your downs. And it's just part and parcel to the game. So take us to one of the lowest periods that you had, so far. And then, tell us what was the main lesson that you learned from that experience.
Wow. Yeah. And I have the perfect scenario. I didn't know this question was coming, but there's one experience I've had and one deal that I did that was like a complete masterclass seminar on how not to do a bunch of things. So the first flip that I tried to do, and this has really turned me off of flips since then, and I only do them if it really makes a lot of sense, was a foreclosure. It was a foreclosure duplex in a really great town in the seacoast of New Hampshire, and the deal itself just needed a ton of work. And like I just tell every investor, like if you're going to do your first deal, make it one that doesn't need that much rehab, because that's really where you're going to lose your shirt if you don't have the experience and don't know what you're doing. So the rehab went way over budget. It was just over my head in terms of what was involved. And a bunch of things that were, kind of out of my control happened where like while we were under contract, the pipes burst. This is the Northeast in the winter. So I had a bunch of mold in the basement when I took over. And the first contractor I hired was stealing materials, and that was a mess. Second one I hired was doing 6 jobs at the same time. That, I always ask, I say, how many jobs you working on right now? Because speed's obviously important with these deals. Oh, I got nothing going on right now. I can work on this deal. And it was like a referral from like a trusted investor in my network. So I was like, all right, this will be good. Turns out he was doing 6 jobs. A couple of his guys quit. He was spread thin. He was only at the job site once or 2 days, once or twice a week. So I was in this project for I was in it for a year. It took me a year and a half to sell it. Lost a bunch of money. It was a complete pain in the ass. So as for what I learned from it, right? Now when I'm doing a rehab that is larger in nature. Like I've just realized that like I need to be a babysitter. You have to be a babysitter. Like it's crazy. It doesn't matter how experienced your contractor is and how well you trust them. You got to be there. You got to be there multiple times a week. And if they're not working out, you need to move on quickly. I moved on quickly for my first guy, and I didn't move on quickly for my first guy. And the same thing with my second guy. It wasn't until the third contract that I had it done. And in hindsight, right, I should have said, he's only been here, once or twice a week for the last 3 or 4 weeks. Like we're moving on next. And the way I paid my contractors at that time too was we separated all the portions of the job. I pay half up front, half when it was complete. Now I do like 25 or 30% up front, and then 30% in the middle and the majority at the end. I parcel out the payments a little bit more. But at the time, we had done a number of jobs together. I was like, I'll pay you half up front, half when you're done. Like, it's not the way to do it. You got to pay so little up front to keep them incentivized to keep coming to the property. And God forbid you have an issue like I did. If you have to fire them and walk away, you don't have to chase as much money, or you're walking away from not as much money as if you pay half up front and they only get 10% of the job done. And then you're like, find yourself in a paralyzing situation. So when you're doing rehabs, especially large rehabs, you just really need to be, it's a job. It's an active job. You have to be there. You have to babysit, and you have to be mindful of how you're structuring your contracts with your contractors. So I would say that that's probably my big learning experience, is just a masterclass in how a renovation can go wrong. But a lot of great lessons learned on that one for sure. I could talk about that a whole podcast if you wanted me to, but I'll stop it there.
No, I love it. And I mean, it really rings true for me because people who have not done flips, your contractor is going to be the linchpin to that experience. I mean, sure, you got to buy it right, but if you're not there on site, I guarantee things are going to go wrong. And if you're not there, there's no accountability. I like that the big lesson that you learned was do a little bit up front, more in the end. I've had a problem doing 50-50 as well. And so great experiences, great lessons learned. Sorry you had to go through it, but now you come out the other side, and it sounds like you've got those lessons in the bag. So you're not going to make that mistake again.
Exactly. And you're going to make a mistake if you're investing in real estate at some point. Hopefully it's not too big. Hopefully it's not as big as mine, right? But you learn from them. So you got to look at it as paid education, right? That's how I view it.
Absolutely. Last question on kind of your experiences, or more your advice for people, in real estate or in investing, or just getting into investing. If you were to go back to the Axel, who is just finishing flipping cars, just getting into real estate, and you were to give that guy one piece of advice, what would it be?
Become extremely focused on what you want and why. I spent so much time learning about flipping and wholesaling and rental property, and just all the different things you can do in real estate. And shiny object syndrome is a real thing, and I got caught up in that. It took me a bit to realize flipping wasn't for me, and the rental property investing was. And then I spent so much time trying to buy condos and single families before I was like, let's just even a small multifamily is a better rental property than a single family, especially in my market. So I spent so much time just planting shallow seeds, if that makes sense, rather than planting less deep seeds, which is really what you got to do. You got to be like, this is exactly the strategy that I'm going to follow. These are the people that I need to talk to in order to make this process easier, and just put your blinders on and just do that, and just commit to doing that for a longer period of time, 7, 9 months, a year. I'm not going to try and flip houses. I'm not going to try and wholesale houses. I'm just going to look for multifamily properties. And once I did that, I started to get some traction. But I spun my wheels probably from age 19 to 21. And then even after I bought that first property, I was still like, oh, maybe I want to flip houses. A $40,000 check will help me buy rentals. And it does, but it's harder to find the rentals when you're doing that. So I would have just been a little bit more clear about what I wanted and what needed to be done to get there.
Absolutely. And I loved one thing you said. You said, put the blinders on. And that is, I've had shiny object syndrome, or whatever that thing is. I've had that happen to me multiple times, especially when you first get into real estate. There are so many different ways to go about doing this game. I mean, there's different asset types, different strategies. You could loan, you can buy, you could wholesale. And when you just get into it, you just want to do it all, but that's not the way to do it. Choose one strategy, put the blinders on, and go towards it, because that's the way that you actually get good at that one thing.
Exactly.
Awesome. Well, Axel, thank you very much for coming on the show. I appreciated it a lot. And I'm sure everybody listening and watching did as well. We all need things in our lives. You're no different. You've already given us a lot. So if someone were to bring something to you, what would you want to receive?
Oh, that's a good question. Well, first of all, I appreciate you having me. Second of all, to answer that question directly, I mean, it's deals. Who doesn't want deals, right? You know, I like to work with folks that are newer investors and kind of show them how I find deals, and the processes that I follow, and then I basically just teach folks how to do that. And if you find a deal you want to bring with me, I'm happy to partner on it with you. Happy to pay you for that deal. Learn something, make some money. And as I'm looking into new markets, specifically a couple of markets in Alabama, a couple of markets in Northern Florida, and, you know, really the Southeast, as I try and buy larger properties, I'd love help in doing that. And if anyone's listening to this in New Hampshire, probably maybe a handful of any, but always looking for deals up there as well. So feel free to reach out to me. I'll show you how I find deals, give you the playbook. And then once you do find one, if you want to, you know, wholesale it, if you want to take it down yourself, I'm happy to be a resource for that too. You know, so, and I can, I don't know if you have a segment for this, but I can kind of share how people would connect with me. And if they did do that.
That is my next question. If somebody did want to get in contact with you, what would be the best way to do that?
Sure. So you can find me on Instagram. It's at Multifamily Wealth. And then, or you could just search Axel Ragnarsson. You'll find me on there. You can email me off there too. I mean, my email is in my profile. You can find me on LinkedIn, Axel Ragnarsson on LinkedIn. And I also host a podcast myself. It's called the Multifamily Wealth Podcast. And we talk a lot about multifamily real estate, but there's a few episodes in there too about, you know, smaller multis and single family investing as well. So any of those channels will be the best ways to reach me.
Awesome. I love it. So you guys heard it. If you want to get in contact with Axel, he's on LinkedIn, Multifamily Wealth. Was that it? The
Multifamily Wealth. Yep.
Multifamily Wealth. He's on Instagram, Multifamily Wealth. And I will put the link to LinkedIn, his LinkedIn profile below. So if you want to get in contact with him, you can reach out there.
Great.
All right. Again, Axel, thank you very much for coming on. We appreciated all the wisdom you shared. For everybody else, we look forward to seeing you guys on the next episode.
Awesome. Thanks again for having me.
Thank you for joining us on the Real Estate Investing Club. If you've watched this far, I'm sure you've gotten a little bit of value out of this. So we would appreciate it if you hit that thumbs up, share it with your friends or family, whatever it may be. And if you'd like to share or partner with us on a deal, we absolutely love partnering on deals and are always looking for quality projects. Go to www.therealestateinvestingclub.com to get in contact with one of our partners. Otherwise, I hope you guys have an absolutely fantastic day, and I look forward to seeing you on the next episode.